Look, you've got maybe $500 sitting in your account, maybe $1,000. You open your brokerage app, you see Amazon at $190, Nvidia at $130, Apple at $210. And you think, I can buy 4 shares. How is that supposed to change my life? So you sit on it, paralyzed. Here's the thing, though. That paralysis is the exact psychological trap keeping regular people out of generational wealth, and I want to demolish it today. Because there is a category of asset that most retail investors ignore completely. And once you understand the physics of how it moves, you will never look at a $5 stock the same way again. My name is Conrad, and I spend way too much time thinking about asymmetric risk and how ordinary people build extraordinary wealth from small starting positions. If you're someone who feels like the real money was already made, that Apple, Tesla, and Nvidia happened without you and now you're just watching, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Today we're building the full blueprint, from a $5 stock entry to a 7-figure retirement fund. Let's get into it. Here's what most people don't realize. On a $5 stock, your downside is mathematically capped. It goes to 0. You lose $5 per share. That's it. That is the maximum damage. But the upside, there is no ceiling. Monster Beverage traded under $1 in the late 90s. It became a multi-$100 stock. Companies in biotech and AI have gone from sub $5 to double digits in under 18 months, repeatedly. Now, I'm not saying every $5 stock does that, most don't. But here's the concept that changes everything: positive expectancy. You do not need a high win rate to build life-changing wealth. You need your wins to dwarf your losses. The math: 10 trades. You lose 7 of them. $500 each, that's $3,500 gone. But your 3 winners go up 300%, 500%, and 800% on $500 positions. That's $8,000 in profit. You were wrong 70% of the time and still netted $4,500. That is the asymmetric return model. The volatility that scares people away from these stocks, that volatility is the mechanism for massive returns. This is where it gets really interesting, because that same principle applied with compounding is what turns 4 figures into 7. Let me show you the math that I think most people have genuinely never seen. A $5 stock going to $10 is a 100% return. Simple. Now, how long does it take Apple or Microsoft to deliver 100% from current prices? Historically, 4 to 7 years for a large cap in a normal market. A $5 stock with a real catalyst? We've seen that move in 8 months. Start with $5,000. Year 1, doubles to $10,000. Year 2, another double, $20,000. Year 3, one more, $40,000. By year 5, even a 50% return on the compounding base is moving serious money. You're crossing $100,000 inside of 6 years from a $5,000 start. And from there, the path to $1 million compresses dramatically because you have real capital working. Now, right now, in 2026, we are sitting inside a specific window that makes this more urgent than it's ever been. Following the Fed's rate pivot cycles in 2024 and 2025, mid-tier AI infrastructure companies and biotech firms are undervalued. Institutional money that was locked out during the high-rate environment is rotating back in toward exactly these companies. Real technology, real revenue pipelines, stock prices still depressed from the 2023 to 2024 risk-off sell-off. That window has a clock on it. The positions that produce 500% and 1,000% returns over the next 5 to 7 years are being accumulated right now. The question is whether you're in them. Here's what frustrates me. People treat low-price stocks like a lottery. They see $3, they throw money at it, and they're shocked when it goes to 50 cents. Low price is not a strategy. Low price is a number. You need a filter. I call it the survival metric. 3 quantitative criteria that separate legitimate growth candidates from companies headed for delisting. 1. Cash runway. The company needs at least 18 to 24 months of operating cash on hand without needing to raise capital. Dilutive raises in volatile markets destroy your stake. Check the quarterly filings. This is public information. 2. Debt to equity below 0.5. In the current 2026 lending environment, companies carrying heavy debt are fragile. Lean balance sheets survive volatility. Over-leveraged companies don't. 3. Rising institutional ownership. This is the one most people miss. When hedge funds and pension managers start accumulating a $5 stock, they know something. I want to see at least 15 to 20% institutional ownership as a floor. And I want that number increasing quarter over quarter. That pattern is visible in public 13F filings. Smart money accumulating is the clearest signal you can find. Now, you might be thinking, Conrad, this still sounds risky. And yes, it is. But risk that is understood and sized correctly is completely different from risk that's ignored. Which brings me to the most important section. I've watched smart people pick the right stock and still lose everything because they sized the position wrong. If you put 40% of your portfolio into one $5 stock, a 30% drawdown will break you psychologically. You'll panic sell, lock in the loss, and then watch the stock do exactly what you thought it would, without you. The fix is the Kelly criterion, practically applied. Never allocate more than 2 to 5% of your investable portfolio to a single position. On a $20,000 portfolio, that's $400 to $1,000 per stock. You can hold 20 to 50 positions. If 5 go to zero, you've lost $5,000 max. If 3 do 400%, you've made $12,000 to $15,000. The portfolio survives. The strategy continues. And here's the psychological math you need to accept before you enter, not during. You will see 30% drawdowns. A stock you own drops from $6 to $4.20. Every financial media outlet tells you small caps are dead. Your brain screams sell. The investors who reach 1,000% exits are the ones who understood, in advance, that 30% drops are the tuition fee. Sized correctly, with the survival metric as your filter, you hold, because you know what you own. Final piece. Once a position doubles, pull your original capital out. Let the house money ride. You are now playing with pure profit, and your initial stake is redeployed into the next opportunity. You are never risking more than you started with. This is where most people never arrives, because they sell too early or hold too long. 3 signals tell you a $5 stock has matured. The market cap crosses $2 billion, explosive phase is over. Analyst coverage expands from 2 to 15 plus analysts, your edge is gone. Or debt rises without matching revenue growth. The business is buying time, not building it. When 2 of 3 appear together, you rotate out. Where does the money go? If you're holding inside a Roth IRA, your gains compound completely tax-free. A 10 times on a $5 stock in a Roth is a 10 times you keep, every dollar. For taxable accounts, holding past 12 months for long-term capital gains treatment is not optional, it's foundational. The end game, once your portfolio reaches a threshold you define, say $500,000, you begin rotating realized gains into dividend-producing assets. REITs, dividend growth ETFs, preferred shares, assets that pay you to live without forcing you to sell anything. The speculative sleeve keeps compounding in the background. The income sleeve funds your life. That is the transition from wealth accumulation to permanent retirement. And it is absolutely achievable from a $5,000 start, if the strategy is executed with discipline. Look, the people who build serious wealth from this market cycle are not the ones waiting for perfect information. By the time CNBC tells you the bottom is in, the move is over. The window right now, in AI, in biotech, in fundamentally solid companies that are still depressed, has a clock on it. Institutional capital is rotating. The positions that produce 1,000% returns over the next 5 to 7 years are being built right now. You understand the asymmetric physics. You understand positive expectancy, the survival metric, Kelly sizing, and exit architecture. The math works. The only question left is whether you apply it, or whether you let fear keep you on the sideline while other people build the retirement you deserve. Hit subscribe. Drop a comment. What's your current portfolio size and what's stopping you from making your first move? I read every single one. I'll see you in the next one.